Have you ever stared at your bank account, feeling like you're stuck in a financial maze with no way out? That feeling of being trapped, like you're working so hard but not getting ahead. You're definitely not alone. It's a common struggle, but what if I told you that the key to breaking free might be simpler than you think? Often, it's not about how much you earn, but about the small, everyday habits that either build your wealth or drain it away. Today, we're going to shine a light on 6 of the most common money habits that keep people from achieving financial freedom. By the end of this video, you'll have the knowledge to spot these traps in your own life and, more importantly, the tools to start building a brighter financial future. So grab a notepad and let's get ready to transform your relationship with money. Let's dive into the first and perhaps most critical habit: paying yourself last. Think about it. When your paycheck hits your account, what's the first thing you do? For most people, it's a frantic rush to pay bills: the mortgage or rent, the car payment, the utilities, the credit card statements. The list goes on. After all that, if there's anything left, maybe a little goes into savings. But what happens on months when expenses are higher? That's right, savings gets nothing. This approach essentially puts your own financial security at the bottom of the priority list. You're taking care of everyone else, your landlord, the bank, the credit card company, before you take care of the most important person, your future self. It's a reactive way to manage money, and it's a surefire way to stay stuck in the paycheck-to-paycheck cycle. Now, imagine flipping that script entirely. What if, the moment your money comes in, the very first bill you paid was to yourself? This is the core principle of paying yourself first. Before a single dollar goes to anyone else, you automatically transfer a set amount, 10 or 20% of your income, directly into your savings or investment accounts. Treat it like a non-negotiable expense, just like your rent. By doing this, you're not saving what's left after spending. You're building your future on a solid foundation. You're prioritizing your goals, whether that's a down payment on a house, a comfortable retirement, or just a robust emergency fund. This simple shift in mindset from reactive to proactive is the single most powerful step you can take towards financial independence. It guarantees that you are consistently building wealth, month after month, no matter what other expenses pop up. Next up, let's talk about a silent wealth killer: the debt trap. In our world, it's incredibly easy to live beyond our means. By now, pay later isn't just a slogan. It's a lifestyle for many. We're bombarded with offers for credit cards with tempting rewards, zero-interest financing for new furniture, and loans for the latest car. It feels like you can have everything you want right now. The problem is, this convenience comes with a very high price: interest. Using credit to finance a lifestyle you can't actually afford is like walking on a treadmill that's gradually speeding up. At first, you can keep up, making the minimum payments. But soon, the interest starts to compound, and your balances grow faster than you can pay them down. That beautiful sofa you bought for $2,000 could end up costing you $3,000 over time. You're not just paying for the item, you're paying a premium for impatience, and that premium is your future wealth. Falling into this trap means your hard-earned money isn't going towards your goals. It's going to the banks and credit card companies. It creates a cycle where you constantly working to pay for past decisions instead of building for your future. The psychological weight of being in debt can also be immense, causing stress and anxiety. The key is to shift your mindset. Before swiping that card, ask yourself, can I afford to pay this off in full when the bill comes? If the answer is no, it's a red flag. Living on a cash or debit basis forces you to be honest about what you can truly afford. Breaking free from the debt trap isn't about deprivation, it's about empowerment. It's about ensuring that every dollar you earn works for you, not for someone else. Alright, let's move on to a more subtle habit, one that can sneak up on you even when you're doing well professionally. It's called lifestyle inflation. Have you ever gotten a raise or a new, higher-paying job and felt ecstatic? You think, finally, I'll be able to save more and get ahead. But then, a few months later, you look at your bank account and wonder where all that extra money went. This is lifestyle inflation in action. As our income increases, our spending tends to rise right along with it. A bigger paycheck leads to a more expensive apartment, a fancier car, more frequent dinners out, and pricier vacations. We justify these upgrades as rewards for our hard work. And while there's nothing wrong with enjoying the fruits of your labor, the danger lies in letting your expenses grow at the same rate as your income. When this happens, you're effectively staying on the same financial treadmill, just at a higher speed. You're not actually getting ahead. You're just living a more expensive version of the paycheck-to-paycheck life. You might look wealthier on the surface, but your net worth isn't growing. The secret to combating lifestyle inflation is conscious spending. When you get a raise, make a plan for that new money before it even hits your account. Decide to allocate a significant portion, maybe 50% or more of the raise directly to your savings and investments. This way, you can still enjoy a modest lifestyle upgrade while turbocharging your wealth-building journey. It's about creating a gap between what you earn and what you spend, and making that gap as wide as possible. That gap is where financial freedom is born. Now, for a topic that makes most people's eyes glaze over, but it's arguably your single biggest expense: taxes. So many of us treat taxes as something that just happens to us. We work all year, and then once a year we hand over our documents to an accountant or plug them into some software and hope for the best. We see the final number, we sigh, pay it, and move on. This passive approach can cost you a fortune over your lifetime. Understanding the tax code isn't just for accountants. It's for anyone who wants to be smart with their money. The government actually provides numerous incentives and legal ways to reduce your tax burden. But you have to know what they are and how to use them. Think about it. Are you taking full advantage of tax-advantaged retirement accounts like a 401k or an IRA? Contributions to these accounts can often be made with pre-tax dollars, lowering your taxable income for the year. If you're self-employed, are you diligently tracking and deducting all of your legitimate business expenses? Do you know the tax implications of different investment types? For instance, long-term capital gains are often taxed at a lower rate than your regular income. Becoming tax efficient isn't about evasion. It's about smart and legal planning, taking the time to learn the basics, or working with a qualified professional can literally keep thousands of dollars in your pocket each year, money that you can then use to pay down debt, save, or invest. Don't give away more of your hard-earned money than you absolutely have to. Finally, let's talk about putting your money to work. A common mistake is thinking that saving money is the end goal. You diligently pay yourself first, avoid debt, and control your lifestyle. You've built up a nice pile of cash in your savings account. That's fantastic. But if that's where the journey ends, you're missing out on the most powerful force in finance: compound growth. Money sitting in a standard savings account is actually losing purchasing power over time due to inflation. To truly build wealth, you need to move from being just a saver to becoming an investor. Investing is how you make your money work for you 24/7, even while you sleep. Getting started doesn't have to be intimidating. You don't need to be a stock-picking genius like Warren Buffett. For most people, the best approach is to start with low-cost, diversified index funds or ETFs that track the broad market. Once you have a solid emergency fund of 3 to 6 months' worth of expenses saved up in cash, you can begin to channel your extra savings into these investment vehicles. Think of your investments like a garden. You plant different seed stocks, bonds, real estate, and with time, patience, and consistent contributions, they grow into a lush forest of financial security. The earlier you start, the more time compounding has to work its magic. Even small, regular investments can grow into a substantial sum over the decades. Don't let fear or a lack of knowledge keep you on the sidelines. The biggest risk of all is not investing. So there you have it, 6 habits that can silently sabotage your financial well-being. From paying yourself last and falling into the debt trap to letting lifestyle inflation run wild, ignoring tax efficiency, and being afraid to invest. Recognizing these patterns is the first, most crucial step. Now it's time to take action. Pick just one of these habits to work on this month. Maybe it's setting up an automatic transfer to your savings account. Maybe it's finally creating a budget to track your spending. Small, consistent changes are what lead to massive transformations over time. Building wealth is a marathon, not a sprint, and you have the power to change your course starting today. Thank you so much for spending this time with me. I hope you found this valuable. If you did, please give this video a thumbs up, and don't forget to subscribe to the channel for more content designed to help you master your money and live a richer life. I'd love to hear from you in the comments below. Which of these habits resonated with you the most? Let's continue the conversation. Until next time, take care and take control.